This is an argument which has been widely there, particularly in the last couple of years. This actually started almost from the COVID times, when everybody had time sitting at home, they had time to do online analysis. Since that time, this argument is going on, whether it is active or passive. Multi-asset, a bit tricky, Today, a customer who goes and picks a fund online, he may not be able to decide it correctly. He may not be able to judge the taxation aspect also. So there are two different taxation which comes into play in multi-asset.
Hello sir. There is always a confusion on how to choose the right mutual fund. So for the young ones who's going to start an SIP, would you suggest to invest in large cap or flexi cap?
So somebody who is starting in mutual funds first, and if it is an SIP, so the tendency will be, I don't know how much risk I can take. First of all, they should do a risk profiling. They should go through an expert who will first do a risk profiling and then ideally suggest a scheme. Now, if somebody is not doing that, okay, and he wants to choose, if for academical purpose also, let's think about, somebody who's young who wants to start, there is no need to be that conservative to choose a large cap fund. One is because he's young. So when you are young, you have time on your side. When you have time on your side, you can actually take risk. When I say time, this is a person who is going to work for, say, at least 20-25 years. And then this 25 years is a good enough time that he doesn't have to necessarily only stick to a large cap. So what he can do, he can choose a flexi cap, because the flexi caps also, most of the flexi cap for that matter, stick to at least 50% plus in large caps. So they invest more than half of the investment in large cap stock. Only the balance goes into mid and small caps. And even there also, most of the funds take a higher exposure to mid caps than the small caps. So 50% plus is in large cap. Among the balance also, it's higher in mid cap, lesser in small cap. So this kind of an exposure helps them to do the conservatism through the 50% plus in large cap. The balance will spurt the returns when the opportunity is bright in mid and small cap. So he doesn't have to necessarily look at a large cap. And for that matter, while only SIP, normally also today, somebody who is not very old, who is just in the up to 40s, even late 40s for that matter, the large cap exposure can be almost taken care by the flexi cap itself. One is, it's not necessary to have too many funds, and have few funds. Let flexi cap take care of the large cap exposure also, when most of the funds have more than 50% in large cap. And flexi cap is a better solution for many cases instead of having a standalone large cap fund.
So since we discussed about the flexi cap, what's the main difference between multi-cap and flexi cap, sir? Because both looks the same.
Yeah, so when you go by pure language, flexi and multi looks very similar, but there is difference. Technically, a flexi cap fund is allowed to take any amount of exposure in large cap, mid cap and small cap. So they have the complete freedom. There is no restriction. As per SEBI, the freedom is completely there with the fund manager. He takes the call how much to have in each market. But in multi-cap, there are clear restrictions. In multi-cap fund, minimum 25% has to be in large cap, mid cap and small cap each. So then you have the balance 25%. The balance 25% is the fund manager's call. But the first 75% clearly has to be 25% in large, 25% in mid and 25% in small. So with the first one, flexi cap has complete flexibility, fund manager can take his call. But very clearly, as we discussed earlier, most of the funds take a higher exposure to large cap, though there is no restriction or no particular rule that so much has to be in large cap. In multi-cap, this specification is there. So clearly, on the risk side and the return opportunity side, for somebody who is investing long term, the multi-cap can offer a higher return scope. However, when there is a market fall, a multi-cap may fall more because they have 25% minimum in mid and small cap, whereas a flexi cap may relatively have a lower exposure to mid and small cap. So in plain terms, we can say risk and return is higher in a multi-cap as compared to a flexi cap. So flexi cap and multi-cap are not the same. Very clearly, there is difference. Then flexi cap has been into existence for a very long time. Of course, the rules have been different. SEBI has been changing the rules for various reasons across, several times. SEBI has changed the regulations. So flexi cap, at least in various forms, has been there. In 2020, end of 2020, around September, SEBI came with these regulations for multi-cap. Until then, there were some funds in the name of multi-cap, but up from then, that is from September 2020, it has been very clear. Any multi-cap fund has to follow this route. So today, if you see track record, actually a multi-cap fund has only less than a 5-year track record. whereas flexi cap funds have a longer track record. Having said that, this is not to say anything that one is superior to the other. Very clearly, high risk, and if somebody wants to take the flavor of everything in a single fund, a multi-cap fund actually satisfies that. That kind of a satisfaction may not come through a flexi cap, because a flexi cap may tend to have 60-70% in large cap. Only the balance 30 percentage may be in a mix of mid and small cap. So the better allocation to the each market caps, that is kind of an even allocation, and of course the balance 25% alone can be at the fund manager discretion. So for somebody who wants to have the proper package of a mid and small and large, then multi-cap is the solution.
Great, sir. So what's the main difference between multi-cap and multi-asset? Because the name looks like it's the same.
So normally, when you speak to even investors who have been investing on their own, and people who have some knowledge about or having read or heard about mutual funds, tend to get confused between these two. Yes, they both have the same prefix of multi, and there it is multi-cap, here it is multi-asset. Very clearly, if you go deep into the name, there is a clear differentiation. So multi-cap means you have the exposure only into equity, but in various market caps with 25% each in large, mid and small. So this is pure equity. Multi-asset has multiple asset classes. So it is in relative terms, in terms of risk, multi-cap is more riskier because it is 100% equity fund. Multi-asset relatively isn't, because it's a hybrid fund. It would have exposure into equities, debt, commodities, mostly silver and gold, and it can even take exposure into foreign equities, REITs and InvITs. Return opportunity is also relatively high when it comes to a multi-cap, because it's a pure equity fund with exposure to all the market caps, whereas hybrid funds may not deliver close to the multi-cap return, but in a cycle of say 1-2 years, even take the last 1 year, when we saw a fall from September, and if there are global uncertainties, particularly geopolitical tensions due to which the market is falling, the gold exposure in a multi-asset fund can do very well and give a very good return, whereas a multi-cap fund would have got affected because of the market fall. So during market falls, particularly geopolitical tensions driven or even otherwise, the exposure into equity, which is 100% in a multi-cap fund, will see that mostly the fall will be equal to or sometimes lesser or more than the index. Whereas in a multi-asset fund, typically they generally have about 50-60% in equity. So if market falls 10%, this may fall only 5-6% on the equity side. But there is also exposure to debt and gold. There is a good chance debt and gold may even cover this 5%-6% fall, because they may not fall and they will still may give that 5-6% return. So in a market fall of 10%, there is a good chance your multi-asset fund has not fallen at all. So somebody who is looking at long-term wealth creation, has a time frame of more than 5 years and who is young, has to look at a multi-cap fund if you are just comparing fund to fund. Of course, no portfolio can have only one fund for that matter. Based on the risk profile, and if somebody is building a portfolio, it has to have a couple of funds. I am just saying, if you have to compare these two funds just as a investment option, the multi-cap is for long-term wealth creation. Multi-asset is for the less aggressive or a relatively conservative exposure in the portfolio. And somebody who's old also, for he may have to choose a multi-asset instead of a multi-cap if he doesn't want to take that risk. So both are completely different. Both are for a different purpose, and the risk return are completely different. So accordingly, they have to choose these funds.
So what will be the tax bond in this multi-asset and multi-cap?
So multi-cap is a pure equity fund. So the taxation up to 12 months, that is short-term capital gains tax, is at 20%. And beyond that, it is long-term capital gains, which is taxed at 12.5%. Multi-asset, a bit tricky. Today, a customer who goes and picks a fund online, he may not be able to decide it correctly. He may not be able to judge the taxation aspect also. So there are two different taxation which comes into play in multi-asset. So multi-asset funds which have minimum of 65% in equity will have the regular equity taxation, which is up to 1 year 20%. After that, it is 12.5%. If there is a multi-asset fund, for that matter, if there are multi-asset funds which have less than 65% but more than 35% in equity, then in such case, the taxation up to 24 months is short term, which is on the taxed lap. After 24 months, it will be taxed at 12.5%.
For the young ones who's going to start investing in mutual funds, should they choose active funds or passive funds?
See, this is an argument which has been widely there, particularly in the last couple of years. This actually started almost from the COVID times, when everybody had time sitting at home, they had time to do online analysis. Since that time, this argument is going on, whether it is active or passive, which means passive is nothing but index funds. The fund manager invests only in the stocks of that particular index. It's a Nifty 50 or a Nifty 250, or if it is next 50, all these are in the indices which are already there. The fund manager has no other active job to role play. He just invests in that particular stocks in the same kind of a proportion which is there in the index. So question is, in very often these funds do very well, passive funds do well, sometimes even outperform active fund, because index funds, because there is no active participation of the fund manager, the expense ratio is also low. So in that kind of a scenario, why should I not invest in a passive fund itself? Expense ratio is low. Relatively, maybe I feel even the risk is low. Sometimes the fund manager will play a very active role, but the active role is not really giving any great returns. Then why not invest in a passive fund itself? So if this is a question in the people's mind, one is yes, today index funds doesn't mean only Nifty 50 or BSE 30. It's not just 100. There are low volatility indices. There are momentum based indices. So this way there are new indices which have got evolved, and all these are just 3, 4, 5 years old. Only the Nifty 50, BSE 30 kind of indices, or the Sensex kind of indices, are there for a very long time. So this question came in because even from COVID to now, even now as we speak, the last 6 months also, indices have done well compared to many of the active. And even after COVID, there was a 1-year time frame when this happened, where the index funds did better than the active fund. Now the basic question is, what should be the time frame when somebody comes to invest in equity funds? It is supposed to be 5 years. Yes, it is true, in some pockets of 1 or 2 years, many active funds may underperform an index. For now, we will talk about the indices which are in existence for a long time, which is the Sensex and Nifty. So if it is only for a pocket of 1.5 or 2 years that the indices outperform the active funds, keep in mind there are another 3 years where the active funds significantly outperform the passive fund, which is the index based. So that clearly is proven. We go and see the track record. 5, 7, 10 years time periods, active funds have comfortably outperformed the passive. And you take the low volatility kind of momentum kind of indices, after the market fall to after September, they have also suffered a lot. They have suffered more than the actively managed. So as of now, data available, history proves passive funds do well only for a certain pocket of time. For somebody who is supposed to come into investing into equity with a 5-year time frame, very clearly active funds have outperformed. This is even after considering the extra TER which is there in active funds. Even after that, the active funds have managed to perform well over a long periods of time. So let's look at one more fact also. Whatever you call it as a low volatility, high momentum kind of indices also, or you take even the other, next 50 kind of funds, indices, most of these indices, the rebalancing happens only once in 6 months. So until then, the fund manager, even if he may know or he may think there are other stocks which are not there in the index which are expected to do well, he cannot deviate. He is only supposed to follow the index. So whatever is the fate of the index is the fate of the performance of the fund. So in an actively managed fund, he can simply go and do or execute what is there in his mind in terms of his gut feel, whatever is his research saying in terms of the expected performers. He can go and take exposure as he wants in that, which cannot happen in a passive fund. So these are all the reasons that a timely execution or a timely exit. So even, there are, in the past we have seen certain companies for various wrong reasons were out of the index. Suddenly, but that doesn't happen on a day. Only when the rebalancing happens, they get out of the index. Up till then, they may be part of the index, and the fall in that particular stock will affect the performance of the fund very badly. But if this is the case in a actively managed fund, one is the actively managed fund, for some reason, if he is able to smell it in advance, the fall will totally not affect the fund because the fund manager would have exited already before the fall. And if it is a passive fund manager, even if he knows it, he will have to wait until that particular script is out of the index, and until such time the negative impact will be there on the performance. So these are reasons why somebody should take an active fund, and the TER which is charged in excess in an active fund clearly justified because the long-term performance are clearly in favor of the actively managed funds, and that active management gives the returns, the extra alpha, which investor will be happy to have.
So to summarize this discussion, we have covered on our whether to invest in large cap or flexi cap and the main difference between flexi cap, multi cap and multi asset. And we also covered the main topic whether to invest in active funds or passive funds. So thank you, sir. I hope it will be helpful to the viewers.